RRSPs and why should you care? Contributing to your registered retirement savings plan is one of the most beneficial and efficient ways to both save for retirement and reduce your taxes.
Okay, so let's ask a couple of important questions. Terrence, how does putting money into RRSPs reduce my taxes?
So RRSPs offer immediate tax relief by lowering your taxable income.
Okay, and say I made somewhere around, $60,000 this year. Gross?
Excellent. So you made $60,000 of income, gross income, in 2015. Then you will fall into a tax bracket of a marginal tax bracket of 29.7%.
Okay, how did you get to that percent?
Well, there's this wonderful thing called the Google machine.
Love Google.
If you Google taxtips.ca, it will come up under the rates option, and it's put there by the federal government for everybody to be able to access the tax table.
Okay, I've got it up here.
Excellent. So if you made $60,000, how do you reduce that? How do you reduce your taxes through RSP? Well, if you made $60,000 and you are in a 29.7% tax bracket, you will need to contribute $16,000 to your RRSP to drop you into another tax bracket that will save you 7% over all your taxes.
Essentially, making the contribution just drops my income, and then I fall into a lower bracket, and that way I'm charged a lower rate for my income tax.
That's correct, Ella. Okay. So that's the way to use the RSPs to save for your taxes below. It's a little bit confusing, and everybody knows that taxes are a difficult subject to talk about. But essentially, you can think of it as for every $100 that you contribute to your RRSP, if you're in the 29.7% tax bracket, then you will get a refund of $29.70.
Yeah, that makes a lot of sense, actually. Thank you very much for putting it that way. I like to think of it that way. Sweet. So can I put these savings towards my dream vacation of me going skiing in 3-4 years? I want to go somewhere really exotic and go skiing. Can I put that money towards that?
I would recommend not.
Okay.
RSPs are designed for the long-term investing. The very nature of this type of investment vehicle is such that there's a great incentive to avoid dipping into your savings. We actually will cover more around that in another segment later on in the year around avoid the dip. This encourages, like I said, this encourages you to stay invested over the long run and reap the full benefits of market activities and exponential growth. A great little story that I have that describes the difference between one who dips and one who doesn't.
Okay. The smart and the not-so-smart.
Susan and Ann know each other since they're 20 years old. Both start putting away $100 per month at 20 years old for their retirement. At 30 years, they celebrate their friendship by traveling to Europe, and the cost for that was about $10,000. Susie decided to use her RSPs as she already had around $18,000 saved up from her $100 a month contribution, and decided to pay for it out of her other savings. In other words, she did not use RSPs for that. And then they continued to contribute as the $100 a month as they went along. At age 65, let's zoom forward to age 65.
Okay.
And Susie has a nice little, Susie, who used her money for the trip to Europe, has a nice little nest egg of around $200,000, $201,000 to be exact.
Whoa.
Which sounds like a good little nest egg.
It's amazing.
Anne, on the other hand, has a nest egg of $412,000.
Whoa, even better.
So the dip that Susie took when she was 30 years old cost her future self $211,000.
So that's basically, with compound interest, how much she loses out having dipped into her RRSPs. But correct me if I'm wrong, is there not also a fee or some form of penalty that you pay for dipping into your RRSPs if it's not for something like a home buyer's plan?
There definitely is, and we'll get into that after the break. I just want to finish off before we go to the break. Any income that you earn inside your RRSPs is not taxable until you withdraw it from your account. This means that your investments can grow on a tax-deferred basis right up till the end of the year you turn 71 and fully benefit from compound growth. So
let's ask again, why should I care?
Well, it means that if you take the right steps to take advantage of all the little things within your control, you can ensure that you have a sound financial strategy that will carry you right into retirement, allowing you to enjoy the ride along the way as well.
Yes.
In other words, you should care because
it gives you peace of mind.
Excellent.
I love it.
Okay, thanks very much, folks. We'll go to the break here, and when we come back, we'll take care of a few housekeeping items and the top 4 ways to be aware of when it comes to RSPs.
Welcome back to Dollars with Sense. We are talking about RRSP contributions. Now let's talk about a few housekeeping items regarding RRSPs that everyone should be aware of.
And before we get into that, just want to warn you, and you probably already realize this, that the industry, the financial planning industry, really loves their acronyms. So we're going to be putting in a lot of information around acronyms, RSPs and CRA and others, but we'll do our best to explain them as we go along, so that you can understand. Now, if you have any questions, don't be afraid to let us know. Please connect with us through our Facebook, and we will get your questions that way, our Facebook page of Dollars with Sense. Okay, now, there are 4 main things to keep in mind with RSPs. The first one is your contribution deadline. So you have 60 days after the calendar year end to make an RRSP contribution and deduct that contribution on the previous year's tax return. In other words, to contribute RSPs to the 2015 year, you have up until February 29, 2016 to contribute.
Wait a second, February 29, that's a leap year this year?
Yes, it is. It only comes around 4 times a year, folks, so take advantage of it.
Nice. Okay, so we're January right now, beginning of January. That leaves me 2 months. 2 months to reach my deadline.
Excellent.
Okay. Second thing to consider is your contribution limits. Generally, your RRSP contribution limit increases by 18% of your previous year's earned income to a specific dollar amount.
And that specific dollar amount for 2015 is $24,300.
Okay, so specific dollar maximum. Watch out, though, folks. Rules to determine contribution limits are integrated with limits for pension plans. So if you're one of those lucky guys or girls who are members of a company-sponsored registered pension plan or a deferred profit sharing plan, also known as a DPSP, you will have a pension adjustment, also known as a PA, which is reported on your, here's another one coming, T4s each year.
The T4 is a form that the federal government gives in order to claim your income. So the third is unused contribution room. So if you did not contribute the maximum to your RSPs each year, the contribution room not used has been carried forward and is available for use in subsequent years. And that's been in effect since 1991. So basically, since 1991, if you have not contributed to your RRSP, you right now would have a large amount of room. The largest that I've seen in my experience has been about $135,000, which is a lot of room to contribute to your RSPs. And this represents a great opportunity if you have not taken full advantage of the room, because you can start to make larger contributions. There's actually a very effective way to make the most of this, is to use up the bulk of your uncontributed room or your contribution room when you make the most money. So for example, let's say you made $150,000 this year, you're going to be taxed at 45.8%. But if you contribute for every $1,000 that you contribute to your RSP and you've made $150,000, you're going to see $458 coming back. So it's a great way to, again, lower your taxable income and to save for your retirement.
Finally, in case you don't know how much contribution room you have, the best way to determine your RSP limit is to look at your most recent Notice of Assessment, which is sent to you by the Canada Revenue Agency, let's just call them CRA from now on, after you file your tax return each year. And if you can't locate your NOA, you can either call the CRA or you can check out their website for more information. You just register online and you will have that information available to you at any time.
Yes, as a matter of fact, it's a great to see that the federal government is in the 21st century and you can get all your information online. But like most things with the CRA, it's a bit of a process to get there. So what you have to do is go online to the CRA and apply to have access to your account. And then they mail you the passcode. And then after you get it through the mail, then you punch it in and it's up and running. So it does take a couple weeks to get it up and running. Your Notice of Assessment indicates your total available RSP contribution room, including any unused contributions that have been carried forward. We're now going to head to the break, and we'll see when we get back. We're going to talk a little bit more around what the call to action will be. So if you're looking for 2015 to be the year that you take full advantage of the RSPs, then we're going to have a great call to action for you when you come back. Welcome back. We're back here with the topic of our RSPs. Why should you care? So, to answer that initial question that we came up with at the beginning of this, it is good to care because caring saves you money. We do have to say also that you need to rely on your professionals. You need to rely on your professional management team for your wealth. And that includes financial planners like us. That includes accountants and perhaps lawyers if it gets complicated, an accountant, your financial planner, persons like us, or your management team for your wealth. If you don't have a management team for your wealth, I've got a little interesting story around, or not story, but fact around the value of advice. In a study of over 1,000 Canadian households, Ibsen-Reid findings show that the advised households have substantially higher assets than those who do it yourself. For example, those who have a professional advisor with incomes levels between $35,000 and $55,000 had nearly 5 times the level of investable assets compared to those who do it yourself. Further, these findings are consistent with all income levels and age groups. Advisors provide a wide range of valuable services to clients, including the planning and maintenance of targets, helping them to choose the right vehicles and the right assets mixes to achieve those targets. And these results show that good advice adds great value. For example, in the graph that I'm looking at, 55,000 to 75,000, if you fall within that category of income, if you do it yourself, if you're a do-it-yourself investor, according to the Ibsen-Reid polls, you'll be at around $30,000. The same people who make the same amount of money but use a financial planner like ourselves, they're at a level of $197,000. That's almost 7 times the amount of assets by using a financial planner. So it is a really good idea to do so.
That's amazing. Thank you, Terrence. So the call to action item is look for your NOA. Find your notice of assessment that you were sent in February of 2015 in order to find this very valuable information we've shared with you today. And as soon as you file, basically, you receive your NOA with your return. So basically now, January, I did last year file my taxes. And I saw my accountant. It was done online. She made it very easy for me. I received my return within 2 to 3 weeks. And then from 2 weeks after that, I received my notice of assessment. I filed it away. I know where to find it at a moment's notice. And I know what contribution room I have for next year to anticipate savings that I can do throughout the year to reach the target so that I can make my contribution for next year. I'm in control, and it feels really, really good.
Excellent. So that's it for this week's, folks. Thank you to everyone at 98.7 CKPM FM, Tri-City Radio, for giving us the time to be your financial gurus by offering you, the listeners, valuable financial insight.
Check us out. We've got a Facebook page, Dollars with Sense. Our podcasts are available so you can listen to our shows over and over again. If you have any questions, once again, don't hesitate to write to us. Send us questions, and we'd love to answer you. Or you can make an appointment for a personal review of your financial plan at no cost or obligations. Thanks, everybody. Thanks so much. Enjoy the rest of your weekend.
Yes, have a great weekend, folks, and we'll see you next week on Dollars with Sense.